What if there was a way to supercharge your Roth IRA account and significantly outperform the broad S&P 500 without taking on any additional risk to your portfolio? With the stock pick I'll be talking about today, a simple $10,000 investment in the year 2000 would have grown to nearly $122,000, while during the same time frame the broad S&P 500 would only have grown to $40,000. That's a 3x difference. Based on that compound annual growth rate, if we extrapolate that into a longer time frame of 30 or 40 years for a retirement account, you might see results as high as 5 to 10x that of the broader market. And on top of it, the stock pays out a healthy 3.76% dividend yield. In most cases, if something sounds too good to be true, then it probably is. But in this video, I'll tell you the stock pick I'm talking about, why it continues to outperform the market, why it should be held in a Roth retirement account as opposed to a regular brokerage account, and why this could be the perfect time to start buying this stock, as well as doing a deep dive into the financial analytics to showcase its long-term growth. But as always, if you find this video useful, be sure to subscribe for more videos like this. So without any further ado, the stock I'm talking about today is Avalon Bay, stock ticker AVB. Avalon Bay is a real estate investment trust, or REIT. The company specializes in owning, developing, and managing large apartment communities in leading metropolitan areas. Currently, they own 291 different apartment communities containing a massive 86,000 apartment units in 11 states and the District of Columbia. The best part of residential real estate is its long-term stability, since regardless of the prevailing market conditions, one universal truth still remains, and that is everyone still needs a place to live. This provides a very stable revenue stream regardless of market conditions. One of the reasons that Avalon Bay is able to outperform the broad market is the way that REITs are taxed. You see, when a normal company turns a profit, the government taxes the company on that profit. Once taxes are paid, the company might disperse some of the remaining profit to shareholders in the form of dividends, and these dividend distributions are, you guessed it, taxed again. But with a REIT, as long as the company pays out the overwhelming majority of their income to shareholders as dividends, the company itself is not taxed on any of the profits. By eliminating this second tax burden to the government, the company has more money on hand to disperse to you, the shareholder. And as a result of not being taxed twice, REITs typically outperform the broad market. But this tax structure does have some drawbacks, primarily in that the dividend payment from a REIT is considered ordinary income for you, the investor, which may mean a tax rate of as high as 37% federal taxes. These REIT dividends do not get the special tax treatment that most other dividend payments get at a much lower capital gains tax rate, which in a worst case scenario is a modest 20% tax rate. Therefore, REITs tend to lose a little of their shine, especially for high income individuals, due to these higher tax brackets. However, if you hold these shares inside of something like a Roth IRA, the IRA shields you from the negative tax aspects of REITs, so you can enjoy all of the perks with none of the drawbacks. This makes REITs a prime candidate to hold inside of your Roth IRA account. So we can see that this can clearly be a great long-term stock pick to hold inside of your retirement account, but why could it be a perfect time to start buying shares now? Well, as you can see, shares of Avalon Bay have been hit pretty hard in this last year, causing a drop in price from about $250 per share to only $169 today. That's a pretty massive 31% loss in the last year. However, the best time to buy a stock is right after its price has crashed, and it's effectively on sale, being able to pick up more shares for the same total dollar amount. This price decrease was fueled primarily due to the rapidly rising interest rates imposed by the Fed in an effort to control inflation. These interest rates are wildly important to REIT companies. A mortgage for a traditional home might be able to lock in a fixed rate for 30-year terms, but commercial loans for apartment complex are usually for much shorter durations, often as short as 5 to 10 years. This means that companies must frequently refinance their existing loans. As companies refinance existing loans into newer loans at a higher interest rate, this negatively affects the company's profitability as more money must be paid in interest payments. After a period of historically low interest rates where mortgages could be had for as low as 2%, today the nationwide average rate is closer to 7%. And while a rate of 6 or 7% is the historical average rate for mortgages over the past 100 years or so, I don't see rates remaining high for very long. You see, when rates were averaging 6 or 7% for decades at a time, we lived in a different economic climate. Since the financial crash in the early 80s, we can clearly see a steady decrease in the overall interest rates. This is not a coincidence. You see, if we look at our total debt of the United States proportionate to our GDP, we can easily see that in the early 80s, our debt to GDP ratio was a relatively low 30%. However, today, it's closer to 130% debt to GDP ratio, and America is one of the most indebted countries in the world. The current U.S. debt stands at a whopping $31 trillion. Now, personally, I've never had to try to make interest payments on a $31 trillion loan, but I would imagine it's not fun. A 1% change in overall interest rates would equate to an additional $310 billion in required annual interest payments. We couldn't afford our debt when interest rates were low, and now we're going to get crushed if interest rates remain high for very long. For this reason, I foresee interest rates dropping significantly once inflation is under control. And when those rates begin to drop, shares of Avalon Bay are going to skyrocket again. So not only are we going to get that nice dividend yield, but we're also going to get significant price increase. So now let's jump over and look at a few of Avalon Bay's current financial metrics. All right, guys, so as you can see, the last year or so has been relatively unkind to Avalon Bay with the rising interest rates. What started off at close to $250 per share is now trading at a mere $169, roughly a 30% decline. However, even with that being said, it still has some very strong fundamentals, with a market cap of around $23 billion and a 3.76% dividend yield. Its forward-looking dividend is about $6.36 per share and has a PE ratio of around 29. But even though the last year hasn't been so good to Avalon Bay, if we zoom out and take a big picture look at the stock, we can see that overall it is definitely trending upwards with a couple of hiccups along the way. Obviously, price was unfavorable during the 2008 housing market crash, as well as when the COVID shutdowns first kicked off, investors were paranoid that people would not have money in order to pay rent, which caused a very sharp decline in the price of this REIT. And lastly, here in 2022, as interest rates begin to spike, you can see the price quickly tailing off. However, on the whole, it is definitely trending upwards outside of these major catastrophes. But if we take a look at their annual statements, we can see just how much this company is growing. Back in 2012, about a decade ago, its annual revenue was sitting at roughly $1 billion per year. Fast forward to today, and we're looking at closer to $2.3 billion. Now, it is worth noting that at least some of this growth is going to be due to an increase in the total number of outstanding shares. You see, part of the problem with REITs is that since the vast majority of their revenue must be paid out to shareholders in dividends, that means that there is relatively little amount of money left over to grow the company itself. So some of this growth is going to be due to simply issuing new shares. You see, roughly a 40% increase in the last decade in the total number of shares. However, just because they are issuing new shares does not mean that when they do issue these shares that the price of the stock decreases. Remember, they're using these shares to generate capital, and with that capital, they are going out and purchasing additional real estate apartment complexes. So even though there is now more shares, your share price has remained unchanged because all of that money was simply reinvested back into the company. But if we take a look at some of their other metrics, you can clearly see that on a per share basis, the revenue per share is steadily increasing. with a 10-year compound annual growth rate of about 4.26% annually. Pretty good. And also you can see the same thing in its dividend payouts. As you can see, Avalon Bay is steadily increasing its overall dividend payout on a per share basis with a 10-year compound growth rate of 5.13%. Now you will notice that during some of these special events, like the 2008 financial crash, they did not pay out a dividend at all. Likewise, in 21, during the COVID shutdown, as a precaution, they did suspend their dividend payouts for 1 quarter, which is evident by the 6-month gap here between the payments in May and November of 21. But prior to that, as you can see, every 4 quarters, every year, Avalon Bay has steadily been increasing its overall dividend payout. And that's what we're looking for as an investor, something with consistent increases in its overall payout, signifying its growth. So that's going to do it for us today, guys. Why I believe Avalon Bay will significantly outpace the broader market. If you enjoyed this video, consider subscribing for more financial videos. And as always, I'll see you all again next time. Thanks.